It's all of these markets in platinum and gold and in silver that have been suppressed in London and in New York for such a long time is being exposed by these big traders that are global, that are sovereign wealth funds for Saudi Arabia, for China, or for India, or for Russia, whoever the hell they are, they're standing for delivery, and they are using the stupidity of the West and their continued manipulating of the market to drain what's available. It's changing. The market is not behaving anywhere near like it used to. And if you see a 7% 1-month lease rate for silver, that's something I've never seen before. So the market is getting very tight, physical supply. And I would expect that if gold goes to the moon, silver will slingshot.
AndySchectman, president and co-founder of Miles Franklin, has been watching silver closely because what's unfolding isn't just another price dip, it's a pressure cooker. Let's start with the numbers. Historically, the gold-to-silver ratio hovers around 50-1. Today, gold is pushing toward $4,000, and even conservative estimates peg silver at $60 to $80 if that trend holds. That's not just plausible, it's mechanical. Silver is simply lagging behind gold's breakout. And the current chart? It looks a lot like gold did just before it punched through $2,200. If silver breaks the $50 resistance zone, the move to $75 could be swift and violent. Canadian investment firm Fidelity appears to share that bullish outlook. Their fund manager, Samson, told Bloomberg they expect gold to hit $4,000 per ounce by year-end. The drivers? A weakening dollar, lower rates, and renewed central bank stimulus. After a pullback from April's $3,500 high, several funds have added to their gold positions, betting this is just a pause, not a peak. But here's where it gets exciting and potentially explosive. Schectman reports that an anonymous trader recently shorted 440 million ounces of silver at around $37.50. That's not standard behavior for commercial banks. And with silver now trading above $38, that position is already $250 million in the red. Whether it's a hedge gone wrong or a manipulation play, it signals something deeper. Stress under the surface of the silver market, and the technical picture reflects that stress. Silver got struck in early Wednesday trading, not because of fundamentals, but because the dollar caught a bid. This isn't just about spot prices anymore. It's about trust, leverage, and positioning in a highly competitive and closely watched market. The big money knows what's coming, whether it's the gold-to-silver ratio normalizing, a breakdown in dollar strength, or rate cuts on the horizon. The setup is loud and clear. Silver doesn't move in a straight line, but when it does move, it doesn't wait around. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Maybe the only way to get out of this problem without defaulting or hyperinflating, and that is to use the stable coins to push down interest rates on the front end of the curve to give synthetic demand while they allow gold to come back, revalue it, and peg it to the back end to keep rates at zero, to bring back manufacturing. I mean, I see it happening. And if that's the case, you're going to see this just everywhere very quickly in an effort to keep demand going for a country that is maybe 25% of its way to its obligations just by 2028. And those are the bonds that are in circulation, let alone everything else. So, yeah, I think it's going to be fast and furious, Jared. I really do. I think they've already pushed the price down to the level that they were trying to keep it under, or close enough anyways. They put on a 440 million ounce short position, they being, it's interesting, I'll tell you that in a moment, but whoever they is, because Bix Weir was talking about the fact that the commercial banks, their playbook is traditionally to short a rising market. And this time they didn't short the market as it went up to 39. He says it's a classification on the Commitment of Traders report that is other traders or unknown traders. They're masked. We don't know who they are, but the commercials did not short. Whoever the hell it is this stupid game that the COMEX continues to play. They did knock it down, and you know, the commercials did put at some point a couple weeks ago, they did put on 440,000 ounce short at 37.50. But then the price went up and they didn't short it. Someone else did, whoever that someone else is. Maybe it's the BIS. I don't know who the hell it is, but whoever it is, they're stupid as a mud wall. So at the price right now of roughly, what do we got? Roughly on silver. So they're roughly $500 million right now in the hole. Not quite. No, half that. About 200. They're $250 million. About $250 million that they're bleeding at when it was at 37.50. That's when 440 million ounces were sold short. But there's a 90% correlation between silver and gold throughout all of history. I look at silver right now from a technical standpoint to where gold was a year and a half ago. I think it's ready to explode. And then you look at what's happening in London, as an example, with lease rates that have blown out to 8%, with exchange for physical premiums that have blown up by 250% in 2 days last week, where most of the last 2 weeks there were zero shares available anywhere in the market to buy of SLV, to cover or to short. All of this screams of tightness in the silver market. And when you realize that in London right now, that the platinum lease rates, I know you asked me about silver, but it's tied in, and it's tied in because the platinum lease rates right now are nearly 30%. And the head of the Tokyo bullion market, he came out and says that in his mind, London appears to have virtually no physical platinum available for delivery. And he says, I'm going to read it here, it seems that there is really no platinum in local London or Zurich, yet continued trading of nearly 3 million ounces per day of London promissory note cash contracts for immediate platinum ownership and delivery is something is about to break. And he goes on to say that if you're paying 30% interest to borrow, you might as well just go out and buy it. But really what he's going on to say is that, and he also said he's never seen a time. He used to run the trading desk for ICBC, Chinese bank, but he says the revelation of this and the frailty of the platinum market will knock on to the London Metals silver market. And the rates are 7 to 8% lease rates. It's going to shine a light on it. In other words, all of these markets in platinum and gold and in silver that have been suppressed in London and in New York for such a long time is being exposed by these big traders that are global, that are sovereign wealth funds for Saudi Arabia, for China, or for India, or for Russia, whoever the hell they are, they're standing for delivery. And they are using the stupidity of the West and their continued manipulating of the market to drain what's available. It's changing. The market is not behaving anywhere near like it used to. And if you see a 7% 1 month lease rate for silver, that's something I've never seen before. So the market is getting very tight, physical supply. And I would expect that if gold goes to the moon, silver will slingshot. And look, if you just use the silver to gold ratio, you got all the banks saying $4,000 gold by the end of the year. If you realize 50 to 1, it's been higher than that on par for the last 150 years on average. That puts it at $80 an ounce. Even at 70 to 1, which is way higher than its average for the past 150 years, you're at 60. So yeah, I do think that silver will go much, much higher than people think possible. And from a standpoint of technical analytics, it's right where, almost identical to where gold was just about a year ago. We could expect it to break through the resistance, just like gold broke through 2,200 and then went off to the races, gaining another 50%. I would say that's what you should expect to see, and maybe even much more because of the suppression of silver so overtly for so long that really, not to mention the resistance between here and 50. There are a couple of spots at 42 or whatever, but those numbers were only, you have a couple weeks or less of trading time cumulative in the two peaks before, went up, went down, and so those resistance levels are quite meek as far as I'm concerned. Once it gets up into the upper 40s and does break through 50, if it follows gold's suit.
AndySchectman, echoing economist Jim Rickards, says the U.S. may have no choice but to let gold rise, not just modestly, but dramatically. The target? Somewhere between $7,000 and $8,000 per ounce. And that's before any formal revaluation. The idea is simple. By allowing gold to reprice higher, the U.S. could effectively devalue the dollar, making exports more competitive, recharging domestic manufacturing, and quietly addressing the unsustainable debt burden. It's a move former President Trump has publicly flirted with, and it fits into a larger pattern of weakening the currency to regain economic leverage. A leading commodity strategist recently projected gold could hit $7,000 by 2025, a 135% jump from today's $3,000 range. If that plays out, it would mark one of the most aggressive runs in modern history. For investors who position themselves early, the returns could be enormous. But here's the kicker. This isn't happening in a vacuum. It's unfolding against the backdrop of a debt spiral that's starting to spin faster. Let's get back to the interview.
I think it's a bigger picture. I think the stablecoin initiative is done to fill the void of all of the treasury demand we've lost on the back end of the curve, but they're going to stuff it into the front end of the curve. They're going to do very short-term duration issuance of treasuries off of stablecoins, which will fill that void, and I think they're going to do that in spades at the same time, as Luke Roman says, anesthetize the back end of the treasury market. And I think they will peg the back end of the treasury market to gold. And I do think it will be at a much higher price. In fact, Luke even talks about letting the price get to 7,000 or 8,000 organically and then revaluing it to a much higher level. Now, it's important to remember, as we've mentioned on your show before, Jared, that gold is held on the balance sheet of the U.S. government in what's called the revaluation account. That's the name of it. Of course, you can't make that up. And every $4,000 increase in the price of gold would result in $1 trillion given to the Treasury General account. I'll explain how the whole mechanism works. It's as simple as a Treasury Secretary saying to the head of the Federal Reserve, Jerome, hey, Jerome, put the price of gold at $24,000 an ounce. Now, who would that benefit? Well, it would benefit all of the central banks of the world. It would arguably benefit the United States government. I would argue they're probably behind the massive importing of gold that we've seen since November. North of 100 billion that we know of since November. And there's probably a whole lot more that they're buying through proxy banks around the world, in Switzerland and in London, in Singapore, wherever they're doing it, or even through local and artisanal miners, as we find now that the central banks have admitted to doing recently, to disintermediate the marketplace. Same thing China's been doing. But anyways, the idea is you bring back all of that gold. Now, when you realize that we've weaponized the dollar and that we are inflating it away at a reckless abandon, people say, well, what do you mean by that? How do you know we're inflating? Well, first of all, the CPI is a lie. It should be called the CP lie because they massage the numbers to make us believe inflation is under control. John Williams of Shadow Stats, who just uses the way the numbers used to be measured, previous administrations would say you add an 8 to that, and it's about 11% inflation, if not higher. But the point is simply this. We weaponize the dollar. We have irresponsible fiscal policy and brain-dead monetary policy. They just came out with their estimate for the third quarter in terms of the amount of debt they'll need to issue. $1 trillion is the number in 90 days. They're going to need $1 trillion. That's at least $3 trillion a year in deficit spending for the next 3 years. When you realize that in 3 years, 2028, we need $28 trillion just to pay for the bonds that come due that we've already issued. Add the $9 trillion in deficit spending minimum, you're at $37 trillion. In the next 3 years, we'll take in $15 trillion in tax revenue. So we're just over 1/3 of the way there. How do you continue to do that? Well, you print, you inflate, which is what they have to do because there's no demand for our treasuries on the back end. In fact, all these countries are selling, right? And so we're supposed to believe that the United Kingdom is now number 2, surpassing China. It's two broke guys leaning against each other to not fall over. You know, the UK is one of the most indebted nations in the world, only second or third to the United States. So one debt country buying the debt of another broke country. And so here's what I think they're going to do. I think they will let gold rise organically, and at some point they will revalue it to a level high enough. And the reason I say 24,000, and that's the number Jim Rickards comes up with, and he has a metric of dividing M2 or whatnot into the price of gold. And so if the Treasury Secretary did say to Jerome Powell, let's say gold's at 7,000 or 8,000 a year from now, and he says, go ahead, push it up to 24, it would work. Or whoever the Federal Reserve Chair is at that point, it would work without congressional approval. You just simply go do it like this. Hey, head of the Fed, put gold at 24,000. Who does that benefit? Well, it benefits the U.S. for sure, but it would also benefit all of the central banks who have been buying gold hand over fist. So you're not going to get a ton of pushback there. But when you look at the mechanism of doing that, in essence, what you would be doing is wickedly devaluing the dollar, which is something they're going to want to do. You already see the dollar down 11%, and Trump has come out and said, in fact, let me just see if I can find the actual statement that he just came out and said. I just thought, he says, Trump said he liked a strong dollar, but you make a hell of a lot more money with a weaker one. So when you have a strong dollar, one thing happens. It sounds good, but you don't have any tourism. You can't sell tractors. You can't sell trucks. You can't sell anything. Manufacturers will be the first to benefit from a falling dollar. Japan and China fought for weaker currencies for decades and were able to dominate markets over the years. Now, it doesn't sound good, but you make a hell of a lot more money with the weaker dollar. So if they bring all this gold back, like we've seen, huge amounts, 100 billion that we know of, they devalue the dollar by revaluing gold. So the dollar goes way down. In other words, I think they're going to sacrifice the dollar, Jared. They're going to inflate it away to save the system. So you have the stable coins pegged to the short end of the market, which keeps the engine going. You put zero coupon on the long end, zero bond rate, zero, and peg it to gold. So deliverable in gold at maturity, so that the more reckless our monetary policy is and irresponsible our fiscal policy is, will only increase the value of gold at maturity. So you can have a zero coupon bond on the back end. You make it redeemable in gold. You revalue the price of gold way higher, which devalues the dollar. Now you are in the perfect position to do what? Bring back your manufacturing at a low value of the dollar and low borrowing costs. In fact, zero borrowing costs on the long end. You bring back your manufacturing. You say to the world, this is what we need to do. You say to the U.S., we need to do this in order to give our children and grandchildren a future. We're bringing back our manufacturing at zero borrowing costs and a weak dollar, which stimulates the exports to begin with, but allows us to reshore, build the manufacturing capacity, train the workers, do all of these things so that we actually have a chance to grow our way out of this problem. When you have the indebtedness issue that we do, there's only one way to pay for it, and that's print or default or growth. And the growth is out of the question until we bring that stuff back. But unless you have a weak dollar and low borrowing costs, you can't do it. Furthermore, how do you pay $28 trillion in long-term debt obligations that are due in 3 years if you only take in $15 trillion in revenue? So it's an issue where I think the stable coins will keep the game going, and then they peg gold to the long end with a zero interest rate coupon in order to bring back manufacturing to grow our way out. So yes, I do think they will revalue gold. I truly, truly do.
Schectman highlights the numbers, and they're ugly. The U.S. needs to borrow $1 trillion this quarter just to maintain current operations. By 2028, that figure balloons to $37 trillion in total debt, while projected tax revenue is only $15 trillion. That's not a budget gap, that's a fiscal canyon. On Monday, the Treasury confirmed that it will borrow $1.007 trillion in the third quarter, essentially to rebuild cash reserves depleted during the last debt ceiling standoff. This comes just weeks after new legislation signed on July 4th raised the debt ceiling again, this time by $5 trillion, bringing the limit to $41.1 trillion. You can't solve that kind of imbalance with policy tweaks. You solve it with inflation, or a currency reset, or both. And that's why the conversation around $7,000 gold isn't wild anymore. It's becoming part of the toolkit, a monetary reset hiding in plain sight. What's unfolding isn't just about price charts or technical patterns. It's about trust in the entire structure propping up the financial system. Silver's sudden volatility, oversized short positions, and explosive potential aren't just market quirks. They're symptoms of deeper stress. At the same time, gold is being positioned not just as a hedge, but as a policy instrument, quietly pulled into the conversation as a lever for systemic reset. With debt exploding, the dollar wobbling, and investor behavior turning defensive, the signals are no longer subtle. Something big is shifting, and fast. If metals are becoming the pressure valve for a monetary system stretched to the edge, how long before the market stops reacting and starts repricing everything around that new center? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.